Welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan. Today we're going to look at some interesting stuff that happened in the market this week regarding the non-farm payroll and how this SPY kind of looks like it's running out a little bit of steam here. A bunch of people done videos on this. We're not going to repeat anything we already said. It's new stuff. It's not, we're not one of those channels that just tries to pump out all this crap.
Yeah. Well, if you guys enjoy following along with the adventures of just two stupid guys trading stocks, by all means, give us a like and subscribe below. We'd love to have you guys join us on this journey. With that, we'll get to it.
Two stupid guys trade stocks.
I like this picture here because the Hogwarts Express and the SPLI, they share something in there. They're both magical.
Yeah, and completely realistic.
Yeah, exactly.
Yeah, so essentially, the non-farm payroll, it's just basically the number of workers in the U.S. excluding farm workers and workers in a handful of other job classifications, yada, yada. So the big numbers that came out was the expectation is supposed to be 720K, right? In reality, it was 235K.
Yeah.
And what did the market do, Vinny?
I didn't care.
Didn't care.
Yeah, it barely moved.
And I do have a theory as to why that happened. However, it's important to understand why this jobs miss was like more important than other jobs misses. So here, go to the next slide for me. This is the full year of job reports. Okay. Now, if you'll notice, the first 6 months is super chaotic because we were still dealing with a lot of COVID stuff.
Yeah.
Right. So because of that, I disregard that a little bit, but we should have been stair-stepping our way. We were expecting a little bit of a decrease, but not just this massive drop off.
Yeah.
It's
pretty substantial.
It's very substantial.
Yeah, I would say
so. Here's the implication. So if you'll notice, I had enough room on the SPY chart on the bottom section to put in a whole nother photo because stocks don't ever go that way.
No. Warren Buffett would agree. Over the long term, they go up.
This is 5 months. We still got plenty of room.
I know.
So the actual is obviously the actual numbers. The forecast is the forecast numbers. The arrows that you see here are actually the date that the information was released. So the green arrows are the green arrows that super beat, right? Like the first April 2nd, 916K to 647, we beat it by almost 300,000.
Nice little gap up there.
Nice little gap up. The reds are the ones where we super missed. Okay. And then that pink is like we missed, but barely. It's June 4th. We only missed by 100K compared to the previous 800 or 700K. So if you'll notice, we then reported horrible jobs reports.
Yeah.
And we're chilling right there.
Yep.
It's pretty interesting.
Interesting. Yeah, I know, right?
A little bit weird.
Yeah. I have a theory. I'm curious to see what your theory is, if you agree.
My theory is in this, and I also have stuff to back it up.
Okay.
So September is statistically the worst month of the year. Okay. Going back, this is kind of blurry because the photo was so small. It was on Bazinga. But basically, since 1960s, the dark blue, past 20 years is light blue, orange past 10, and then post-election, obviously, September sucks. It's irrefutable. Sure.
It's funny because like October is classically the day with like a lot of really bad days, like Black Tuesday or whatever was like October,
Yeah,
but
that's just 1 year.
Yeah,
this is every year. The argument against this is on the right, the recent numbers.
Yeah.
Right. So the recent numbers be like, well, hold on. If you look at this in a micro view, we're fine. That's whatever.
Maybe.
Maybe.
Yeah, exactly. The rules don't apply anymore.
Exactly. So one possible answer is that the jobs report was bad, meaning Jerome Powell may put off said taper, thus interest rates stay low. So at his economic outlook, he was very optimistic at our current standings, as in optimistic that we will reach maximum employment. In my opinion, it sounded like he was giving foreshadowing of a bond taper, but we don't care about opinions. So I'm just going to read a little excerpt from his speech. We have said that we would continue our asset purchase at the current pace until we see substantial further progress toward our maximum employment and price stability goals measured since last December. When we first articulated this guidance, my view is that substantial further progress test has been met for inflation. There's also been clear progress toward the maximum employment. At FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it would be appropriate to start reducing the pace of asset purchases this year. Not in the future, this year. And then he goes on, he says, hey, we're killing it. He just does that for like another 3 paragraphs. I'm not going to bore you.
Yeah, that's exactly what I was thinking too. Like, this just helps the market kind of feel a little bit more reassured that quantitative easing, the Fed purchase of that $120 billion worth of combination of MBS and treasuries every month, may continue for a little while longer if we aren't quite getting back to full employment based on this over 500,000 job miss for the month of August there. I'm sorry,
yeah.
July.
And this seems so weird to me that we're hoping, if you're going long the stock market, that the jobs report sucks. That is just the weirdest, most like confounding, just like it's just goes to show that the economy is not centered around the stock market. We're hoping for horrible news to make the stock price go up.
Yeah.
Like, what on earth? And then also on top of that, I don't know, I'm in Arizona, you're somewhere else. I don't know if you wanted me to say your state. I don't know. You're on the East Coast. I have job openings at every single store within like a 5-mile radius of me. Like every single place is like, please hire. You have people doing outrageous bonuses like Target. I think Walmart and Chipotle are paying for your college.
Yeah, I don't know how much they're paying for it, but yeah, I agree. Same thing around here. You're kind of seeing a lot of companies are really doing whatever they can to encourage applications. It's
insane. It's absolutely outrageous. All right, go back to the thing. So the next FOMC meeting, September 22nd. This is going to be a terrifying day, an utterly terrifying day, because we don't know what's going to happen. Also, full disclosure, I go to the next one. You're good. Does everyone remember that? I don't know if anyone saw this. A decent amount of people saw it, but I had predicted right there that this would probably go to like 450s, and then we were going to see a crash. It's lined up pretty well, in my opinion.
Yeah, you were a little too soon, maybe. I don't
know. I said it's going to go to 250s, and then we're 450s. We're at 453, baby. I'm still right there.
All right.
I didn't say 460s though.
Yeah. We'll
so if we look at this graph, boom, chilling up here. I talked about that here. I was like, this can go even up to the 450 range, but eventually we're going to come back down to earth. One thing I want to show you is the RSI. That's this blue line. Do you know what the RSI is, Vinny?
Yeah, it's Relative Strength Index is what it stands for. It's designed to show market overbought, oversold conditions.
Got it. So look at my green line. Here we are right now. How long do you see blue lines on top of that line in the last year?
I mean, often for the last year, I guess, compared to historical averages. It seems like pretty often for compared to historically what I'd expect.
Often, but regardless, it pierces it, but it usually comes right back down after.
Yeah, it doesn't stay above it for too long.
Here, crash, here, crash, here, a decent amount of time, crash.
Yeah.
Crash, crash, crash. So that does not bode well, in my opinion. Also, you'll look that we keep on bouncing off of this 50 moving average. I feel like we're probably going to come back down to it. I was going to buy some puts. One thing I did want to show you is just to look at a macro view. When stocks fall, they fall hard. Like, this is crazy. Look at the green versus the red, the arrows, it's kind of ridiculous. You can go back to the thing, man.
Yeah. Makes perfect sense. I mean, obviously, like yeah, the down days are always much harsher, I guess you could say, than the up days. It takes several weeks of up days to be erased in like one single bad down day.
Yeah, and for full disclosure, I have after that video was released, I bought SPY and Q puts, and essentially my stock market or my stocks are going up slower in my account because of it, because I'm using it as an insurance policy. Like I lost $1,400 on those puts in the last month and a half, and then I just renewed them. So it is what it is. I'm going to keep doing this because I'll get less gains, but if something happens, I'm fine.
Yeah.
Like, I'm not super worried about it. If there's a monster crash, if anything, I'll be positive.
Yeah. It's funny, like
strike prices.
Everyone has a different way of doing that. You're doing protective puts. Really, my whole thought process basically is the companies individual stocks that I buy, I feel have enough underlying value that I'm okay with them crashing, and potentially it will be a buy the dip situation.
Yeah. So I also have a bunch of cash just sitting off to the side too. I think I'm half cash. Yeah, I'm half cash. When's the last time you heard me say that?
Yeah, I'm like zero cash right now.
I'm usually half margin.
Yeah. Nice.
All right, guys, let us know what you think about that non-farm payroll report and what's going on in the market. Give us a like and subscribe if that's cool.
We'll catch you in the next one.
Later, guys.